and today we are going to present the mini case of Google Tax. In order to analyze the case thoroughly, we are going to elaborate by identifying the core problem, followed by the analysis and recommendations, and then before going to the four questions of the mini case. Global tax system faces a growing challenge as digital businesses like Google and Apple exploit differences in taxation rules. Traditionally, tax laws were designed for physical businesses with clear location and activities. However, digital companies operate across borders, often without a physical presence in the countries where they generate revenue. This discrepancy creates confusion. How should companies that primarily operate online be taxed? Google, Apple, and others take advantages of gaps in the system, shifting profit to low-tax jurisdiction, often referred to as tax haven. These strategies exploit mismatches between how countries define taxable presence and the global nature of the digital businesses. As a result, governments lose billions in tax revenue while multinational companies minimize their tax burden, leading to the growing calls for reform of the global tax system to address the imbalance.
Moving on is a case analysis where we will provide quantitative and qualitative analysis.
The entire case revolves around the intellectual act of tax avoidance by a digital business. Arguably, the two most important elements in a digital business are its intellectual property, how it delivers its services. First element: intellectual property can be sold and licensed, but that sale and license can be different incorporated subsidiaries of the same company. The second element is how and where the service is provided and delivered. Google's business in Great Britain serves as an example. The primary operations of Google are in Ireland, but most of the customers are in England. A Google consultant will visit potential customers in London and aid in the understanding of Google services. Google describes these employees as marketing leaders and not salespeople. The customers will then go online and connect with Google's operations in Ireland to purchase desired services. The purchases are purchased from Irish business and subject to Irish taxes. Through this digital delivery structure, Google generated hundreds of millions of dollars in business in England while generating few English tax liabilities, much to the distress of English authorities. So, the topic of tax avoidance done by Google brings us to the offshore tax strategy used by Google called Double Irish Dutch Sandwich, which is based on two different Irish subsidiaries to execute ownership and sales. All of the ownership of its intellectual property is assigned to one Irish subsidiary, while all of its European sales are assigned to another Irish subsidiary. Both enjoy Ireland's lower corporate income tax rate, lower than rates in other countries like the UK or France. Google's Irish subsidiary also benefit from a quirk in Irish tax law that stipulates that companies controlled from a foreign tax environment, including from a tax haven like Bermuda, only pay tax in that foreign country, not Ireland. Key to Google's tax structure is the subject of permanent establishment. Tax rules allows a firm like Google to fix a tax base in a low tax country like Ireland, while generating lots of business in a country where tax rates are higher, like the United Kingdom. Companies in principle are taxed not on where they do business, but on where they finalize their business deals with customers, the country or jurisdiction where the final contract is signed. In the case of Google, that most sales in European Union are finalized in Ireland, where the corporate income tax rate is only 12.5%. If Google's employees in the UK were actually conducting sales activities, then UK offices would have been interpreted under tax law as permanent establishment, leading to higher corporate income tax rate. The qualitative analysis of the case. Tax avoidance or tax evasion. The strategy was legal but seen as ethically questionable because it allows multinational corporations like Google to minimize taxes in countries where they generated significant revenue. Regulatory arbitrage. The loophole exploited difference between tax laws in the UK, Ireland, Netherlands, and Bermuda, creating an unintended gap in global tax policy. Third, government response. OECD, Organization of Economic Cooperation and Development, and BEPS, Base Erosion and Profit Sharing, push for reform. EU and US government criticize Google and other companies, leading to policy changes. Introduction of Google taxes, like UK's diverted profits and Australia's multinational anti-tax avoidance law, aims to curb such practices. Impact on stakeholders. Smaller businesses operating in the same market as Google could not leverage such tax loopholes, creating an or unfair competitive landscape. Highlighted flaws in the international tax system. Double Irish Dutch sandwich was a legal but controversial strategy that highlighted flaws in the international tax system. In 2015, the pressure mounted to such a degree that Ireland revoked the ability of companies to execute double Irish Dutch sandwich. Google announced on 2019 New Year's Eve that 2019 would be last year it used the tax structure. There has, however, not been international consensus on the best way to move forward on the taxation of digital services. In 2019, President Emmanuel Macron brought into law France's own digital services tax, much to the displeasure of the United States. Digital services tax imposed a 3% levy on gross revenue generated from providing two types of digital services: digital services like digital interface services in France and targeted advertising services in France. The US opened a Section 301 investigation that such a law was targeting digital services provider, and July 2020 imposed retaliatory tariffs. Those tariffs, scheduled to go into effect in January 2021, were suspended under Biden administration. G7 agreement in 2021 implemented a global minimum tax rate of 15%, narrowing tax differences to help reduce tax distortions. So, following are the recommendations for this case. First, the government should adopt and enforce 15% minimum tax rate agreed through OECD, BEPS, and G7 agreement initiative. Second, digital taxes introduced by France, Australia, UK should be carefully structured so they target tax avoidance without discouraging digital innovation. Ireland's and third being Ireland's 2020 removal of the double Irish structure was a good step, but loopholes remain global. Countries should harmonize tax definitions and residency rules to prevent companies from exploiting inconsistencies between tax jurisdictions. Tax authorities, and fourth being, the tax authority should simplify international tax rule so digital transactions are paid where product is consumed, not produced. And fifth recommendation being tax authorities should redefine location of taxable transactions from country of supplier to the country of buyer. And sixth recommendation being invest in local markets to justify taxation. Firms should increase local research and development and job creation to demonstrate their contribution.
Just elaborating on the recommendations that mentioned in the previous slide, the 15% minimum tax rate agreed upon by the OECD, BEPS, and the G7 is a key step in tackling tax avoidance, such as the tactics used by Google in this case, which is the double Irish Dutch structure. This global tax rate ensures multinational companies pay their fair share even if they move profits to low tax countries, creating a more balanced tax system. On top of this, digital taxes like those in France, the UK, and Australia need to be designed carefully. These taxes should target companies avoiding taxes but without discouraging innovation. For example, France DST was seen as unfairly targeting American companies like Google, so a more balanced approach is necessary to ensure fair contribution while supporting growth. Additionally, harmonizing tax definitions and residency rules across countries is crucial to prevent companies from exploiting differences in tax laws. The Google case showed how businesses could avoid taxes by shifting profits between jurisdictions. So, standardizing this rule would ensure companies pay taxes where they do the business. Another key change would be to tax digital services based on where they are consumed, not where they are produced. This would be matched with the reality of the digital economy where value is created through consumer use, ensuring that countries with larger user base get the tax revenue they deserve. Similarly, shifting the taxable location from supplier's country to the buyer country would ensure that taxes are paid where digital services are used, stopping companies like Google from avoiding taxes in markets with high demand. Lastly, companies benefiting from global markets should invest in local economies through research and development and job creation. This would show their contribution to the countries they profit from, justifying their tax obligation and building better relationship with those nations.
Now we are going to go over the mini case questions. So now question one is going to ask what makes taxation of digital commerce so different and complicated. So for the next slide, we are going to go over a few factors that affect this problem. In today's global economy, digital commerce is reshaping industries, but taxation of these businesses is complex. So let's break it down. First, intellectual property, IP, and licensing. Companies like Google often sell license their intellectual property to subsidiaries in different countries at higher price or royalty rates, and this practice can shift profit from low tax jurisdiction, making it difficult for government to capture their fair share of taxes. And second, service delivery location. Digital services don't have physical boundaries. For example, Google's UK operations may be booked through its Irish subsidiary, despite most of its customers being in the UK. This complicates determining which countries should rightfully tax the profits generated from those services. So digital commerce doesn't follow the same rules as traditional businesses, creating a tricky landscape for tax authorities with cross-border transaction and intangible assets. Finding the right balance between fairness and efficiency is more challenging than ever. As digital businesses continue to grow, so too will be the complexity of taking them. The challenge is finding a system that works for both the global economy and local governments. Question two asks for the reason why it has been illegal for companies like Apple and Google to structure their global operation to a position where profits are recorded for tax purposes. Companies like Apple and Google have been able to legally structure their global operations to position profits in tax-friendly jurisdictions due to several key factors. So the first one is lack of physical presence. The digital nature of their business models mean that Apple and Google do not need a physical presence, such as factories or sales offices, in the countries where they generate significant revenues. So this allowed them to argue that their sales and services occur in jurisdictions where they have minimal physical operations, like Ireland, rather than countries where the customers are located, like the UK. The second one is the intangible goods. Both Apple and Google operate in the digital economy. Digital goods and services such as software, cloud service, and advertising are highly mobile, meaning they can be shifted easily across border without the need for physical presence in a particular country. This flexibility allows companies to book profits in jurisdictions with lower tax rate, such as Ireland. Apple and Google often license their intellectual property to subsidiaries in tax haven or low tax jurisdiction. So by structuring the operation so that IP is owned in a jurisdiction with favorable tax policies, such as Ireland, they can reduce their overall tax reliability. The third point is the tax treaties. Tax treaties between countries often allow multinational corporations to avoid double taxation and structure their operation in a way that minimizes their tax obligation. Companies like Apple and Google leverage these treaties to channel profits into jurisdictions that offer favorable tax treatment. And finally, under permanent establishment rules, companies can establish a tax base in a low tax countries like Ireland while generating revenue in higher tax countries. For instance, Google can operate primarily in the UK but fix its tax base in Ireland where tax rates are more favorable. So, in conclusion, these practices have been legal due to the current international tax rules and the ability of companies to exploit gaps and mismatches in the global tax system. However, they have also led to significant debate over fairness, tax base erosion, and the need to reform in digital economy taxation.
Moving on to question 3, many tax analysts have always considered the double Irish Dutch sandwich to be the result of a series of very special circumstances. Why is that?
Question 4. Many tax analysts have always considered double Irish Dutch sandwich to be the result of a series of very special circumstances. Why is that? So, the double Irish Dutch sandwich was used by digital businesses to shift profits to low tax jurisdiction. Analysts consider it special circumstances due to combination of legal, regulatory, and geographical factors that made it possible. First factor being Google taking advantage of Ireland's corporate tax system. Regulatory factor being that the payments were routed through Netherlands and Bermuda due to different regulations. Geographical factors, like profits, were kept offshore, because of which they remained untaxed in the US. Eventually, it can be concluded that the double Irish Dutch sandwich was a result of very special circumstances because it required a digital company like Google to make complex, sophisticated financial arrangements like dealing with lenient Ireland incorporation laws and Dutch bilateral tax treaties that most companies cannot replicate.
Moving on to question 4, what is most likely the future direction of digital business taxation? In light of the tax avoidance and profit shifting issues faced by multinational companies, which is Google in this case, the future direction of digital business taxation is the end of tax structures like the double Irish and the introduction of digital services taxes. The double Irish Dutch tax strategy was widely used by companies like Google, allowing profits to be routed through low tax jurisdiction, minimizing their tax liabilities. However, this strategy faced increasing scrutiny, and in response to global pressure, Ireland phased it out by 2020. This marked a shift towards greater transparency and fairness in the taxation of digital businesses. Similarly, the introduction of digital services tax, such as France's 3% tax on digital revenues, reflect a growing trend of countries seeking to tax digital services based on where they are consumed rather than where companies are headquartered. Although these national taxes have led to tensions, particularly within the US, they indicate a broader movement towards ensuring that digital businesses contribute fairly to the tax base of the countries in which they generate substantial revenues. Additionally, a key future direction is the need for global consensus, the establishment of a global minimum tax rate, and the development of technological solutions to track and tax digital transactions. One of the major challenges in digital business taxation is the lack of international agreement on how to fairly tax digital services. So, national initiatives like the France DSC have sparked tensions and trade disputes, highlighting the need for a unified global framework as mentioned in the previous slide. Without such consensus, countries will continue to implement divergent tax rules, leading to inefficiencies and conflicts. To address this, international organizations like the OECD are working to create a standardized cooperative tax system for digital businesses. Another development is to push for a global minimum tax rate as seen in the 2021 G7 agreement to establish a global corporate tax rate of 15%. This initiative aims to curb the race to the bottom in tax rate, ensuring that multinational corporations, including digital giants, pay a fair share of taxes regardless of where their profits are booked. Finally, technological solutions will play a vital role in addressing the challenges of taxing digital transactions. So, as the economy grows, traditional systems struggle to effectively track and tax digital services. So, by developing advanced technological technologies to monitor transaction and ensure compliance, tax authorities can better enforce taxes based on where services are consumed rather than where the company is based. So that is all with our presentation. Thank you for listening.